Welcome to part 1 of this online presentation of Financial Statements Made Easy, presented by the Small Business Development Center at Columbia Gorge Community College. This portion of the presentation will introduce you to the balance sheet and help you understand the basic format of this important financial statement. This presentation is one portion of our Financial Statements Made Easy course, so please visit the Columbia Gorge Community College website for information on enrolling in the entire program. This website will be provided later in the presentation. The balance sheet is a financial snapshot of what a business owns and owes at a specific moment in time. The balance sheet will be viewed as of a specific date, but is cumulative from the day the business was started. For example, if you looked at your balance sheet today, it would show the total current balances of all asset, liability, and equity accounts since the business was started. The balance sheet often receives more attention from a lender than any other financial statement. It is also the statement that seems to receive the least amount of attention from the business community. A business with a weak balance sheet will most likely not receive a loan approval, no matter how strong they feel their other financial statements may be. The balance sheet formula can be used to help understand this financial statement. Here we see that assets must equal liabilities plus equity, or said another way, the value of what you own equals what you owe plus any remaining equity you have. As the name implies, the balance sheet must balance. Let's think about this formula for a minute by relating it to something in our personal lives. For example, let's consider an asset such as a house. The value of your home will equal the balance of any loans against it plus any remaining equity. Let's say your home is worth $200,000 and you have a loan against it of $150,000. This would mean you have $50,000 of equity in your home. This equation can also illustrate if there is negative equity. Let's say your home in the earlier example fell in value to $120,000 and you still had the loan of $150,000 against it. In this scenario, your equity is now a negative $30,000. Keep in mind, a business could have negative equity as well. What if your home is paid off and you have no loan? Then we could use this formula to show that the value of your home is also equal to the equity balance. Remember this formula as we continue. It will help you understand how assets, liabilities, and equity are represented on the balance sheet. Let's look at each section of the balance sheet, starting with assets. There are two types of assets we will discuss, beginning with current assets. These are cash and other assets that will be converted to cash within 1 year. Examples of current assets include accounts receivable, which are normally collected within a year, inventory, and any prepaid expenses. Current assets are the most liquid assets of a business. Fixed assets are longer-term assets that are not expected to be converted into cash or sold within 1 year. These are assets which are more permanent in nature, such as land, a building, equipment, and vehicles. Now we will look at the liabilities and equity sections of the balance sheet. Liabilities are classified in a similar way as assets. Current liabilities are obligations owed by the business and are due to be paid back in full within 1 year. These may include items such as accounts payable owed to your vendors, a line of credit, or payroll taxes. Long-term liabilities are liabilities that will be repaid in a year or more. These include loans for buildings and equipment, as these assets are normally financed over a term greater than 1 year. Although we won't discuss it in detail here, let me mention that if assets need to be financed, current assets should normally be financed with current liabilities, and fixed assets are financed with long-term liabilities. Failure to follow this can result in financial problems for a business. As we know from the balance sheet formula, the last component of the balance sheet is equity. This is the net worth of a company, or the difference between what the business has in assets and what it owes in liabilities. Let's take a moment to look at a sample balance sheet from an actual business. Here we see each section we discussed earlier, starting with assets and then liabilities and equity. Current assets are listed here, and we can see these are all assets that we would expect to be converted to cash within 12 months. Here are the fixed assets, which again are more permanent and will be held in the business for longer than 12 months. All assets are totaled here. Moving to the liabilities section, we start with current liabilities, which are due to be paid back in full within the next 12 months. Here are the long-term liabilities of the business, which will be paid back over a longer period of time. All liabilities are totaled here. Last is the equity section of the balance sheet. The equity section is totaled here, and we can see that the balance sheet does balance since total assets equals total liabilities plus equity. Here I'm going to have you complete your own balance sheet using the information given. You will use the worksheet provided in the course materials. Last year, your business retained $1,000 of net income. The cash balance of your checking account is also $1,000. You own equipment worth $10,000 and have a loan against that equipment of $8,500. Your commercial building is valued at $250,000 and has a current loan balance of $123,000. Please pause the presentation and take a moment to complete this exercise. I will show you the solution on the next slide. The sample balance sheet we discussed earlier may be a good reference if you need some help. Here's the solution to the balance sheet exercise. The business has $1,000 in cash, which would be considered a current asset, which we see here. The fixed assets of the business include the equipment and the building. These are shown and totaled here. The total assets of this business equals $261,000. Hopefully you notice that there were no current liabilities mentioned in the information, so this will equal 0. The equipment and building were financed with long-term debt, which is shown here, and the total balance of all liabilities is shown here. The equity section includes the owner's equity of $128,500, which is the equity the business has in the equipment and building. The $1,000 of net profit retained by the business is included here as well. This net profit information would come from the income statement of the business. Here's the total equity. We see that this balance sheet balances as total assets equals total liabilities plus equity. Please take some time to check your results with the solution provided. If you have any questions, please post them in the questions forum in the course. This concludes this online presentation. Please visit this website to learn more about enrolling in this and additional courses. If you are a student viewing this presentation, please continue with the remainder of the online class. And as always, if you have any additional questions or comments, please post them in the questions forum.